Hey everyone, Aidan Gray here, stepping in for Claire today for Pit News on Air. Claire's out this week. She came down with a pretty rough case of the coronavirus, so she says. She's okay. Just a little congested and a lot of drama. She told me to tell you it's all Dr. Fauci's fault. I'll let you decide if she was joking. We all wish her a quick recovery and hope she's back next Wednesday, sipping espresso and misnaming candlestick patterns like only she can. But for now, you've got me. Today's topic is a good one. We're going to shift how you think about income investing. Instead of chasing stock prices, what if you thought about the stock market like you were a business owner? Lan Turner lays out a simple but powerful mental model using YieldMax ETFs, especially TSLY, as a way to understand your investments as income-producing machines. Whether you're new to covered calls or just curious about these high-yield funds, this episode is all about turning your portfolio into a paycheck. Let's dive in.
You know, when you talk about investing, it feels like almost every conversation comes back to just, well, the price, doesn't it?
Yeah, absolutely. It's all, is it up? Is it down?
Should I buy?
Yeah.
Should I sell? You know, the classic buy low, sell high. And look, sometimes it works for some people.
It definitely can. But what if that's not the whole picture? What if focusing only on that price movement means you're missing something else?
Exactly. And that's really what our source for this deep dive gets into. We're looking at a piece by Lan Turner in PitNews Magazine.
Right, and it really challenges that flipper mentality, as the article calls it.
It does. So our mission today really is to unpack this different way of thinking the article presents. Thinking less like someone just trading assets.
And more like a business owner, someone operating a machine that's built to produce something consistently.
Yeah, a machine for output. And the article uses this great analogy, this steering wheel machine.
And run some numbers that honestly look kind of wild when you see them through that business lens. It's pretty compelling stuff.
Okay, I'm intrigued. Let's dig in. So maybe start with the familiar. That buy low, sell high idea, the flipper.
Sure. It's simple, right? You buy something, a stock, whatever, because you think it's cheap, hope the price goes up, and then sell it. Make a profit on the difference.
Like flipping houses, but with stocks. It's all about timing, guessing where the price is headed.
And yeah, that's a way to use the financial markets. But the article suggests the markets are, well, richer than that. It calls them a sandbox.
A sandbox? How so?
Like a place where you can simulate real-world things. Think about getting rent from a property or managing cash flow from a small business or even running a factory machine.
Huh. A financial sandbox where you can build a business model. I like that.
And thinking that way, the article argues, is key to understanding certain kinds of investments, maybe like those YieldMax ETFs people talk about.
Ah, okay. So it helps make sense of those strategies.
Definitely. The piece lays out basically 3 ways to think about investing. First, as we said, the flipper, purely about price changes.
Got it. The market timer.
Then number 2, there's the landlord.
Right.
This is someone who buys an asset mostly to collect income from it, like dividends from a stock or rent, like we said. The asset's price still matters, but the main focus is that regular payment.
Earning rent on your investment. Yeah, that makes sense.
And the third one, which is really the core of this article's argument, is the business owner.
Right.
With this mindset, you're not buying to flip, and you're not just collecting rent. You're actually buying a mechanism, a machine.
Machine?
Yeah, a machine whose job is to produce income consistently. You bought an operation, and what you care about is its output, not really what someone else might pay you for the machine itself later.
Okay, so this is where that steering wheel machine analogy fits in.
Exactly. Picture this. You take, say, $10,000, and you don't buy stock in the usual way. You buy this specific machine. And this machine, its only job is to make steering wheels. And let's say there's a big buyer, like Tesla, just waiting to buy every single steering wheel your machine cranks out. The money you make comes from that flow of steering wheels.
Right. Let's break that down based on the article. So the machine itself, what's that stand for in this analogy?
That's your actual investment. For example, in TSLY, the YieldMax Tesla Option Income Strategy ETF. That's the piece of equipment you acquire.
Okay, so TSLY is the machine and the steering wheels it's constantly producing.
Those are the monthly income distributions that TSLY pays out. That's the product, the output.
Gotcha. And Tesla, the company buying all the steering wheels.
That represents the options market. That's the arena where TSLY operates, using strategies like covered calls and options overlays to generate that income.
Okay, wait. Covered calls, options overlays. How is this machine actually making steering wheels? In financial terms? It's not getting dividends from Tesla, right?
Good question. No, it's different. So TSLY holds Tesla's stock or something that tracks it closely. Then it essentially sells permissions related to that stock.
Permissions.
Yeah, like selling someone the right to buy that Tesla stock from TSLY at a set price in the future. It's like owning a fancy car and charging someone a fee today just for the option to maybe rent it from you next month.
Ah, okay.
That fee, TSLY gets paid for selling that right. That's called an options premium. Those are the steering wheels. That's the income. Options overlays are just different ways of using these kinds of option strategies to bring in cash.
So the income isn't from Tesla itself paying a dividend. It's from TSLY actively doing something in the options market, selling these rights related to the stock it holds.
Exactly. It's running an operation on top of just holding the asset. That's why the potential income, the output, can be so different from a regular dividend.
Okay, that makes more sense. You're operating this income machine.
Right. And here's the kicker, the article's main point. If your whole reason for owning this machine is to make those steering wheels to get that income, does it really matter that much if the machine's market price fluctuates? Like if someone offered you $9 chaos for it tomorrow, or it was suddenly valued at $11.
Yeah. If I'm thinking like the business owner the article describes, maybe not as much, because my goal wasn't really to sell the machine itself.
Exactly. You bought it to turn it on, let it run, and collect the income it produces.
Right. Your focus is the output.
Which leads directly to this core business idea the article brings up, the payback period.
Okay, yeah. Standard business stuff. How long until the income the machine spits out equals what you originally paid for it?
Simple formula, cost of machine divided by annual income produced.
And the article actually runs the numbers using TSLY based on data from early 2025, it says?
Yeah, it mentions a share price around $8.50 at the time.
Okay.
And the annualized payout, the income per share per year, was about $10.09.
Wait, $10.09 income on an $8.50 share. That's a yield of like, what, 120-something%?
Around 122%, yeah. Which is, I mean, a massive output rate if you think of it that way.
Wow. Okay, so let's follow their math. If you put $10,000 into this TSLY machine at $8.50 a share, that gets you, what, about 1,176 shares?
Roughly, yeah. And if each share is pumping out about $10.09 in income per year.
Multiply that out. It's around $11,867 in annual income from a $10,000 machine.
Correct. Now, the payback period, $10,000 initial cost, divided by that $11,867 or so in annual income.
Hang on. That's less than 1 year. Like, significantly less. What is that, maybe 10 months?
About that, yeah. Less than 10 months for the machine's output to completely pay back its purchase price.
That's kind of stunning, actually. Every payment after month 10 is just pure cash flow from running the machine.
It totally reframes the investment timeline, doesn't it? And the article drives this home by comparing it to a more traditional dividend stock. It uses Verizon, VZ, as the example.
Okay, Verizon. What was its situation then?
Had a dividend yield around 6%, so same $10,000 investment.
At 6% yield, that gets you about $600 a year in dividends.
Right. Now calculate the payback period for that Verizon machine.
Okay, $10,000 cost divided by $600 annual income, carry the one. That's 16 2/3 years.
About 16.6 years, yeah.
16 years versus less than 10 months.
See. The article just lays it out and basically asks you, the potential business owner, if your primary goal is getting your initial capital back as quickly as possible through the machine's production, which machine do you buy?
Yeah, the difference is stark when you frame it purely around payback from operations.
It really forces you to consider what you're prioritizing.
Of course, no business is totally smooth sailing, right? Even a steering wheel factory has issues. Supply chains break down. Machines need maintenance.
Absolutely. And the article acknowledges that. These YieldMax machines aren't perfect. They have risks.
Like what? What are the snags for TSLY?
Well, it goes back to how it makes the income. Those options premiums, the price of the steering wheels, they aren't fixed. They depend on market volatility, demand for those options.
So the monthly payout, the income, it can go up or down.
Exactly. It's not guaranteed to be the same every single month. That's a risk. And of course, the actual price of the TSLY shares themselves the market value of your machine that can definitely go down over time.
Market risk for the asset itself.
Right, for sure. But the article argues, from that business owner perspective, while you see those risks, your main focus is still operating the machine for income.
Because you didn't necessarily buy it intending to sell the machine itself for a profit.
Precisely. You bought it to generate that stream of steering wheels.
Yeah.
So even if the machine's resale value dips, that doesn't stop the production line, ideally. You keep running it, keep collecting the income.
And this whole machine way of thinking, it's not just about TSLY, right?
No, not at all. The article points to others, like APLY, which you could think of as a machine making parts, may be related to Apple, or NVDY for NVIDIA, AMZY for Amazon, GOOY for Google.
So it's like a whole factory floor of different specialized machines, each tied to a different underlying company or sector.
Kinda, yeah. But the core business model, the way the article suggests thinking about them, is the same. You're acquiring and operating income-generating machines within this financial sandbox, not just flipping stocks based on price predictions.
Which brings us to the big mindset shift the article pushes for.
Right. Its final point is basically, if you find yourself obsessively checking the daily share price of something like TSLY,
You're probably still stuck thinking like a flipper.
yeah, and you're kind of missing the point of this particular strategy.
Stop looking at the price tag on the machine, look at what it's producing.
Exactly. So the questions you ask yourself should change completely.
Instead of, did the price go up?
The business owner asks, is my machine running? Is it producing income? Are those monthly payments hitting my account consistently? And maybe most importantly,
Is it paid for itself yet? Have I hit that payback point?
yes. Because once you cross that threshold, once you've received enough distributions to cover your initial cost, that $10 K in the example.
You're in the black, as they say.
Totally. Every single distribution from that point on isn't just getting your money back. It's pure cash flow. It's profit from operations.
And that cash flow suddenly gives you choices.
Big time. Use it to pay bills, reinvest it back into the same machine to compound, or maybe take that profit and go buy a second machine. Start building out your own little factory of cash flow producers.
It really is a powerful reframe. You're not just holding something passively, you're actively managing an income-focused operation.
It definitely makes you view certain types of investments through a completely different lens.
Okay, so let's wrap up this deep dive. We've gone through this PitNews Magazine article by Lan Turner, which really challenges the standard price-focused flipper approach to investing.
Yeah, by introducing this business owner mindset and that vivid steering wheel machine analogy, it gives you a different framework, especially for income strategies like YieldMax ETFs.
And we saw how applying a simple business metric, the payback period, using that TSLY example, really highlighted the potential speed of recouping your investment when you focus purely on the output.
Especially when you put it side by side with a traditional dividend pair like the Verizon example, the contrast was pretty dramatic.
Right. So this leaves us with a final thought, stemming from the article, for you, the listener, to chew on.
If you start evaluating potential investments primarily based on their output, the income they consistently generate, rather than just hoping their price will go up, how does that shift what looks attractive to you? What kind of new possibilities or combinations might open up for building financial streams if you adopt that factory owner perspective, maybe alongside, or even instead of just trying to guess market direction?
You know, the first time I saw a YieldMax ETF like TSLY, I made the same mistake a lot of people do. I stared at the share price like it told the whole story. But after seeing it through this lens, the steering wheel machine model, it clicked. These aren't stocks you flip. They're machines you run. And when they're humming along, many of them can cover their own cost in less than a year. That's a game changer. So the next time you find yourself refreshing a chart 5 times an hour, stop and ask yourself, is the machine still producing? If the answer is yes, maybe, just take a breath. Big thanks to Lan Turner for laying it out so clearly. If you haven't already, hit that Pit News on Air logo and subscribe. We're here every Wednesday, and hopefully Claire will be back next week. Probably over-caffeinated, definitely opinionated, and ready to make fun of me for being way too calm. And don't forget to check out PitNews Magazine over at pitnews.com. That's where you'll find my articles, and where all this wisdom comes from. And where your next breakthrough probably will too. Take care, and we'll see you next time. Honestly, I think Claire's faking it just to get out of editing this one.